How do tax treaty residency tiebreaker rules work for dual residents? Imagine being caught between two countries, each claiming you as a resident for tax purposes. It can get confusing, especially if you have ties to both. When you are considered a resident of two countries under their domestic laws, tax treaties step in to help. These treaties include rules called tiebreaker rules to decide which country gets to treat you as a resident for treaty benefits. They are mainly found in Article 4 of most tax treaties. The process starts with the permanent home test. This checks where you have a permanent place to live. If you have a home in only one country, that country is your tax residence for treaty purposes. If you have homes in both or neither, the next step looks at where your personal and economic ties are stronger. This includes your family, social life, work, political, or cultural connections. The country where these ties are closer is usually your residence. If that still doesn't give a clear answer, the treaty considers where you usually live or spend most of your time. This is called the habitual abode test. If you spend more time in one country, that country may be your tax residence. If this also doesn't resolve the issue, the next step looks at your nationality. If you are a citizen of only one of the countries, that country is often considered your residence for treaty purposes. In rare cases where none of these tests work, the tax authorities from both countries will work together to decide your residency. They will look at your specific facts and circumstances to make a decision. For Asian American taxpayers who have ties to both the United States and an Asian country with a tax treaty, understanding these rules is very important. Even if you are considered a resident in both countries under their laws, the treaty tiebreaker rules help determine which country has the primary right to tax your worldwide income. This way, you avoid paying taxes twice on the same income. To claim this, you usually need to file Form 188333 with the Internal Revenue Service. This form shows you are claiming treaty benefits and helps prevent being treated as a U.S. resident for tax purposes if the treaty assigns residency elsewhere. Remember, these tiebreaker rules only apply for treaty purposes. They do not change your domestic residency status. You might still have to file in both countries, but the treaty helps you avoid double taxation. If you are a green card holder or meet the substantial presence test in the United States, claiming foreign residency under the treaty can impact your U.S. tax status and rules about expatriation. Overall, these rules give a clear process to decide your tax residency when you have ties to more than one country. They help reduce confusion and prevent double taxation. If you have complex residency situations, it's a good idea to review the relevant treaty and consult a tax professional. They can help you navigate these rules and make sure you are compliant while optimizing your tax position.